Leading today's panel, I'd like to welcome our moderator, the Chief Executive of the Hong Kong Monetary Authority, Eddie Yu. Eddie, if you could lead this charge, please. He is going to be joined by Michael Chae, who is the CFO and Senior Managing Director at Blackstone. Next up, we welcome James Gorman, the Chairman and Chief Executive of Morgan Stanley. Following him is Colm Kelleher, the Chairman of the UBS Group AG. Thank you, Colm Kelleher, for joining us on stage. We next welcome Liu Jin, the President of the Bank of China, on stage. And to complete our panel, we welcome David Solomon, the Chairman and Chief Executive of Goldman Sachs. And with that, Mr. Yu, the ship is yours to command.
Thank you very much. The theme of this first session is about navigating through uncertainties. And just now we talked about it quite a bit. The macro risk, inflation, slow growth, high interest rates, geopolitical risk, and even pandemic is still lingering around. And they're all impacting both financial institutions and your stakeholders and your clients, the corporations. And today we have a very, very heavyweight panel to talk about how they navigate or how they help their clients and stakeholders navigate through all these uncertainties. And I will just start because we can't wait to hear from them. I'll start with the corporate perspective. So James, you've been talking to CEOs around the world, whether they're big business or small enterprises. And how are your clients navigate this period of slow growth, rising inflation, much higher cost of capital? How do you see the global macro outlook? And do you see any bright spots?
Well, good morning. That's a lot to chew on first up, but let me try. I mean, firstly, context matters. What we're going through economically now has its roots in the financial crisis. That led to a decade-long period of stimulating policy, monetary policy, and effectively zero interest rates around the world. That was abnormal. Along the journey of the last decade came COVID, and obviously led to a global shutdown. Global GDP was negative 30% during the second quarter of 2020. That was obviously extremely abnormal. So we've had the two largest shocks to the economic system in the last decade that we've probably had in the last 70 years. It's not surprising that right now the markets are having trouble adjusting to that. Nobody should be surprised that interest rates are going up. They're abnormally low, and reserve banks around the world are trying to get them back to some level of normality and even higher for a period because of the rise in inflation. So listen, for chief executives of large and small companies, the issues are profound. Dealing with uncertainty, however, is part of one's job description. So, to start with some of the narrow issues is just what are your COVID policies? What are your protocols about having people back working together? That of itself, and the change in the dynamic in the office space. Secondly, how do you navigate financially a period where what was much cheaper money is less cheap, and it changes your financial position as a company? How do you adjust to that? Thirdly, we're dealing with wage inflation across every part of the world. For the emerging markets, we've had wage inflation for several years. Now we've got it in the developed markets. That's another challenge to add on. And you've got broader supply chain issues and supply inflation because of some of the geopolitical issues that are going on around the world, and post-COVID, the impact on the supply chain. So, and I could keep going, Eddie. There are many issues to deal with, but this is it's a painful transition, but it's not an unexpected transition. And I think we have to keep that in context. My gut is the central banks will, in aggregate, tame inflation. I think it's highly improbable we'll get back to the kind of 1-2% inflation we enjoyed before this crisis, more like around 4% over the next few years, and we'll have to deal with that. We'll have interest rates somewhere between 4 and 5%. We'll have inflation around 4%. This is globally, and obviously unemployment is going to tick up during this period. But listen, this is our job to manage through uncertainty, and you have to accept the market as it is and accept reality and not fight reality.
Thank you, James. I totally agree with you that the past few years probably was a bit abnormal, and we're now really just going back to normality. But that path is painful, causing volatilities in the capital markets around the world. And talking about that, I will now turn to David. Because of these volatilities, we are actually seeing the IPO market globally really dwindling, the corporate bond issuance coming down, it's not performing well. When you talk to the CEOs around the world, what do they tell you about capital flows? And does that sentiment suggest when capital markets activity will pick up, how it will look like in the near future?
Well, thank you for the question, and good morning, everybody. If you listen to what James, just walked to, James describes a period of change and a period of uncertainty. Capital markets are highly, highly geared to confidence. And we happen to be at a moment in time where there's greater uncertainty, and the trajectory of economic growth, the trajectory of interest rates are all more uncertain than they've been in quite some time. So it's not surprising in that environment the capital markets activity has really decreased. History would tell you that when you go through a transition, you go through a change, market participants, capital allocators need time to adjust to that new reality. As James highlighted, we've gone through a decade of very, very easy money, very, very accelerated asset price appreciation, and so you were generally rewarded for deploying capital and deploying capital aggressively. You're now not being rewarded for that, and therefore investors want a much more significant discount, a much more significant risk premium if they're going to deploy capital. One of the riskier things you can do is participate in an IPO, deploy capital to a new company that's unproven, that doesn't have a track record. And so obviously those risk premiums are up very, very significantly. Generally speaking, when we've had these periods in the past, it takes somewhere between 2 and 4 quarters, sometimes maybe 6 quarters, to rebalance. I think we're going through that rebalancing period. I think there's still a significant amount of uncertainty, but as we get into 2023 and we start to have a clear understanding of the trajectory of capital markets, I think you'll see issuers and capital allocators meet again in the middle, although at different valuations and a different cost of capital than they've operated with over the course of the last decade. So I think we're in the process of that journey, and my expectations is that equilibrium will come more into balance in the coming quarters.
Thank you, David. Let me now turn to President Liu. Of course, China's economic growth, what's the macro outlook in China, and also the outlook for particular sectors, especially the real estate, is something that is of a lot of interest to our audience here. So can you give us some comments on the China macro and also the real estate sector in China?
Thank you, Eddie, for your question. And good morning, ladies and gentlemen. This is a good question. Looking into the economic future of China, I think we'd better find answers from the just concluded National Congress of CPC, because everybody knows that it has been made very clear to the world. The leadership of the party is featuring characteristics of the Chinese social system and a major driving force of the Chinese economic development. We say in the Western context, when in Rome, do as Romans do. I would like to suggest that when in China, think as the Chinese do. So in his address in the Congress, President Xi emphasizes many times the high-quality economic development, the high-level opening up, the centrality of an economy and sustainable growth. Obviously, since the beginning of this year, China has experienced headwinds in the economy because of the COVID, on and off COVID outbreaks and the geopolitical tensions. But with the government's sustained efforts, with the continuing optimized solutions and COVID strategies, with the moderate inflation and macro economy monetary support, together with the additional efforts from the financial institutions, we see a rebound of economy in the third quarter with 3.9%. That is a good signal in the Chinese economy. So that's why I would like to rely on the fact that in the future, China, the country, will stick to the centrality of economy, and we see a bright future of the economic development. So our theme of the discussion today is navigating through uncertainties. The storm today is one of them. And I would like to suggest that the best way out of all the uncertainties is to find out and focus on what is still remaining true and certain amid all those uncertainties. For example, it is certain that the economic cycle of expansion and contraction will always dominate the global economy. It is certain that Hong Kong, as a financial center, worldwide financial center, and the important hub of mainland China and the rest of the world, will always remain, with the hard effort and grand plans made by the Hong Kong SAR government, especially in the recent policy address by John Lee, the chief executive. It is also certain that Bank of China, with a history of 110 years, here in Hong Kong 105, will work together with all the international financial institutions to support the economic growth, to support the international financial cooperation, to support the international trade. So all these certainties, just now in the address of John Lee, the chief executive, he listed a couple of hard times Hong Kong experienced in the past decades. But as I remember, ahead of and in each of the hard times, some people just left and came back. A lot more stayed in Hong Kong. And finally, they welcomed the new era, the new development together. That's the certainty of Hong Kong. That's the certainty of the Chinese economy. So once we understand well and grasp all the certainties, we can always find new ways to cope with the uncertainties. Thank you.
Thank you. So don't bet against China and Hong Kong, right? So let's turn to the investor perspective. Let me come to Colm. With all these uncertainties in markets and the macroeconomy, when you talk to your institutional investors, clients, and also the wealth management clients, how is that affecting the investment preferences and also the risk appetite? And in dealing with high inflation, rising interest rates, have they made any changes to their asset allocation strategies? Or whether, even in this kind of investment environment, do you see them go into certain areas, whether in traditional or in alternative investments, that might offer them good returns? Colm.
First of all, I don't have to agree with James anymore, but I will agree with James in that his summary of the great unwind is very accurate, and that's exactly where we are these days. We have record levels of cash in our global wealth management accounts, and in our US wealth management, as James would agree, we've got very high levels of cash too. So clients are clearly on the sidelines. You've had, over the last 9 months, pretty dire returns in both equities and fixed income and commodities, except for selective spots. I don't think, however, we've had a capitulation trade. What we've had is people waiting to reallocate and get some certainty about direction. And I think James is right. There is a feeling that the central banks will get this under control, and then there will be bright spots for investing. We're not seeing it yet. However, we have seen earning multiples in the US beginning to be revised. Valuations are beginning to attract money in certain areas, consumers, healthcare, for instance. Commodities is a selective case for people to look at. If you look at UBS's investment recommendations, we're pretty much neutral or light every asset class at the moment. But on the other hand, if you look out over the next 9 months, you can see projected returns actually looking quite attractive. Not surprising given the base we're at currently. I think the world, however, is 3 parts. Whilst I think we agree the US is relatively attractive on a comparative basis, I think Europe has very big issues, not least of which is a declining size of equity market, but also banking union has ground to a halt in Europe, which means that you've got wrong way risk in the banking sector, which means that it's very hard for the economy itself to grow. And China is, whilst we're all very pro-China, and like Vice Chairman Fang said, we're not reading the American press. We actually buy the story, but it is a bit waiting for zero COVID to open up in China and to see what will happen. The only other thing I would add is that there's clearly been a big investment shift in terms of the way people are investing, and that there's more of a barbell strategy now. Alternatives are clearly becoming a very big sector for people to invest, and we're beginning to see significant demand for alternatives through our network. And I'm very pleased to say that the alternative managers are being very nice to UBS about selling their products through our network as well. So,
thank you very much, Colm. And that leads very nicely into alternative, especially the private markets. We've got Michael here. Michael, how do you think about the private market performance during this period of big market volatility? Has the public market volatility trickled down into your investments? And also in the private market space, where are the opportunities that you think are the most sort of valuable or the best ones? Michael, please.
Sure, Eddie. Good morning, and thank you for having me set up by Colm, and we'll continue to be nice to you and your colleagues, Colm. I'd say first, with respect to the private market dynamics, while private markets are obviously not immune to what's going on, as you know well, they operate differently than the public markets. They don't swing up and down with the same sort of euphoria on the one hand and depression on the other. They are less volatile by design, and both on the upside and downside. And over time, through cycles, they've consistently outperformed public markets, which is why investors are so willing to trade liquidity for that outperformance long term. Against that backdrop, we bring a business model that has some structural advantages, long-term locked up capital. We have dry powder of about $182 billion today, and a long-term sort of buy and hold mindset. And for us, after sort of 4 decades of operating through dislocations, we've tended to come out stronger. I think in terms of some of the trends we're seeing in our portfolio in generally, many parts, echoing what others have said, many parts of the economy are still running pretty strongly, though there's clearly deceleration. We're seeing, the Fed's actions and other central bank actions, filtering into the real economy, but on a lag. And we're beginning to see the slowing of both inflation on the one hand and growth on the other. But the extent to which today really depends on sectors. So, at the tip of the spear, you have sectors like for-sale housing and its related ecosystem, which I think have been most immediately affected by this sea change in cost of capital. The sort of discretionary digital ad spending world is seeing a meaningful slowdown. But on the other hand, in sectors, including ones where we have a lot of exposure, whether it's travel or energy, both traditional and transitional, rental housing, logistics, you're still seeing continued strength, and that's because demand is still pretty robust and there's still shortages of supply, in some cases structural shortages of supply. So, it's a mixed picture that we see. There's a clear deceleration, but, the key tension, I would say, is that we still have a pretty tight labor market, and we're seeing, wage increases in sort of the high single digits. And that combined with, continued rental housing strength, I think means you've got a couple major components of inflation that'll continue to be sticky, and that'll complicate, the Fed's calculus from here. And the result of this is uncertainty and rising caution, and I think, you'll see that reflected from our perspective, among corporates in slowing hiring, more caution around investment spend going into the new year and so forth. To your question about, compelling opportunities to put capital to work, I'd cite a few areas. First, lending money. Providing private credit to borrowers. It's a highly attractive environment for that. You obviously have, floating rate debt, higher base rates, pretty attractive spreads, senior debt in the capital structure at pretty reasonable loans to value, and in our model, a buy and hold to maturity. And so this provides an excellent risk return, in this part of the cycle, always has, and it will here as well. Second, I'd say investing in hard assets with short duration income streams. In our real estate business, as large as it is, about 80% of it is in sectors, that have rents growing at multiples of inflation. In our infrastructure business, that portfolio is performing really well. So that remains, I think, an area of strength in a rising rate environment. Third, within sectors like technology, life sciences, you've got, the underlying innovation continues, but excessive valuations have in many cases are now a thing of the past. So we'll see, I think that'll create opportunities over time. And then finally, just around public company situations, I would say, given the dislocation, while you might not see at this stage, public to privates from firms like us, you will see divestitures, carve-outs, what we call corporate partnerships. We announced a transaction on Monday with Emerson Electric that we're happy about. That I think is a good example of that. So I think you'll see more of that. So, I think it's simple. In an environment where access to capital in the public markets is constrained, the ability for private capital to provide capital solutions is a really important thing to the system. And for us, our business is simply, an at-scale capital solutions provider across multiple asset classes.
Thank you, Michael. Obviously, even in this period of volatilities, there are areas that we can explore in terms of getting reasonable risk-adjusted returns, like private credit and infrastructure, like you said. Before I turn to the floor for questions, I have one quick question for all of you. We are continuing to look at risk in the financial system in the world. We don't know where the fault line is. We don't know where the next black swan is. So for you, what's the one biggest risk that you might see that might keep you awake at night? I know you all sleep for a while at night, but if there's one big risk that you will name for us that we should watch out for, what is it? So shall we start with James first again?
Sure. I think it's inflation. We haven't had this level of inflation in 40 years. I believe the Federal Reserve and other monetary authorities kept rates too low for too long with too much QE. It's an art, not a science, in juggling where rates are supposed to be relative to unemployment, relative to GDP growth. And the probability of us hitting exactly and nailing inflation without bringing unemployment up too much, but keeping GDP growth, it's hard, right? So I think my gut is we're getting there, and some of the early signs on demand side inflation are suggestive of that. On supply side, less so. You can't really control gas prices out of, what the impact of gas out of Russia is for the global economy, but it's inflation. If we nail that, this is going to be fine.
Thank you, James. David?
I'm going to echo a little bit about what James said. Obviously, if central banks find a way to tame inflation, that, meaningfully, they do it in a balanced way, it meaningfully increases the chance of a soft landing. But we spend a lot of time looking at the fact that we're materially changing the market structure that we've lived in for a very, very long time. We've had relatively accommodative monetary policy for over a decade, almost free money. But generally, the trend over the last 40 years has really been for increasingly accommodative monetary policy, and therefore, very, very strong asset price returns. Central banks have supported fixed income markets in an enormously aggressive way. You've had a significant amount of quantitative easing. We're now in a period of quantitative tightening. And all of this, combined with inflation and a very quick tightening of monetary conditions, makes the world more volatile, more uncertain, and it also allows exposures where there's leverage in the system to be amplified very quickly. Right. We saw that in the UK. I think that's a good window into the kinds of things that can go wrong if there are liquidity squeezes or liquidity traps in markets as we tighten conditions. And so I think you've got to watch that all very, very carefully.
Thank you, David. President Liu, what's your thought about the risk on the horizon?
First of all, I'd like to say I slept pretty well in Hong Kong in the past 2 days. And if I had one or two concerns of risks, the spread of geopolitical tension would be one. Anyway, under the geopolitical tensions, any of our economic activities will be heavily affected. By the way, we talked much about the risks in the property market in China today. Let me share with you some of my observations and understandings about it. Last year, since the second half of last year, we did have some problems in the property market. There have been some developers tangling with liquidity problems, construction suspension risks, and even bank loans defaults. But finally, with the government's support, government enhanced oversight of property sales, and the government help in the address of the property-related, developer-related risks. The market is coming back. What we are saying and what is actually expected of by the government is warming up, coming back, better property market. We are pretty confident about it. And I'm sure that nobody than the Chinese government, than the Chinese banks, cares more about the property market because it has too much to do with the manufacturing industries. And then the GDP growth with the financial stability. So don't worry too much. As Mr. Fang said, don't read too much negative reports.
Colm?
What keeps me up at night is the question. It reminds me of a story about Marlon Brando at the Lee Strasberg acting studio. And he was told by Lee Strasberg, "You're a chicken, there's going to be a nuclear attack." So all these other actors were running around panicking, and Brando just sat there clucking. And Strasberg said to him, "What are you doing?" He said, "I'm a chicken. What do I know about nuclear attacks?" The point I'm making is I can only worry about what I can control. And the only thing I can control with Ralph is the health of our bank. So everything else kind of lets me sleep at night. I can't control inflation. I can worry about it. I can't control the global thermonuclear war. So in many ways, I sleep pretty well. Thank you.
Thank you, Colm. Michael, anything?
I'd simply say what keeps me up is the possibility of rising tensions around the world that could lead to serious threats to stability.
Geopolitics as well. So let me open the floor for questions. Before you ask the question, please say your name and also your institution. Yes, one over there.
Thank you. I'm Henny Sender. This was a wonderful discussion. What I wanted to ask you about is where we all went wrong before COVID, when we all thought that technology would be profoundly deflationary, that as the sharing economy meant that, say, cars would go from being a thing to being a service, we thought the issue would be excess labor rather than a labor shortage. To what extent do you think that COVID has just totally made for a secular change, or is it only temporary before we see these deflationary forces coming back into?
Why the sudden swing? Maybe James, you talked about inflation earlier. Any thoughts on that question?
Well, Henny, I think the period we went through with COVID, and we're obviously still going through here, and the constraints and controls and the impact it has on the economy it was life-changing. The last time we had a global pandemic, I think, was 1919 with the Spanish flu of this magnitude. Obviously SARS, MERS, but a global synchronized pandemic that caused GDP growth to be negative 33%. So that's the kind of shock that for all the technology changes that have taken place, it clearly was going to disrupt that. But now we're getting back to normalization. And I think you're seeing unemployment starting to tick up globally. You're seeing some increase in worker participation, people who sort of, the so-called great retirement, as people survived on various government payments, realize those payments have now stopped. You've actually got to go back to work if you're going to pay for your mortgage. We're seeing, so as a result, we're seeing more competitiveness in the labor market, and I think wage inflation will come down. And the digitalization of the economy and the technology changes are not for nothing. There was a lot of hype going into it. There were companies trading at 50 times revenues, which is just insanity. So that's been flushed out, but that doesn't mean the whole digitalization of the economy got flushed out. So I saw it as, clearly the kind of unknown that not even Donald Rumsfeld might have conjured up COVID, and here we are now, and I think we'll get back on track. Subject, of course, to geopolitical and other things outside of the direct economic factor.
Anything to add from other panelists on this point? If not, then I'll turn back to the floor. Yes, Raymond? The mic's coming.
Thank you. Raymond Chow, PwC. And thank you for that conversation this morning. That was wonderful. My question to the panel is actually, we talked a lot about the uncertainties and the risk, which I agree 100%. The one thing that I want to ask the panel and your view on is we didn't talk about ESG. One of the major issues facing the world in the medium and the longer term is obviously ESG issues, and specifically climate issues. And given the many risks that we just talked about, how your view in terms of the financial market, and are we slipping in terms of our focus of building sustainable finance and sustainable growth in the longer term because of these short-term risks that we're focused on, whether it's inflation, whether it's recession, et cetera, that we might have lost a bit of focus of working together to build a sustainable future?
Thank you, especially when we see energy prices going all the way up. Are we losing track on ESG? Maybe Colm?
I certainly don't think we are. There are short-term challenges. However, we know what ESG is. What we're waiting for as financial intermediaries is codification, the rigor and the regulations that go around it so we know what we're reporting, right? So in many ways, it's very loosely defined at the moment, as you know, right? And there's no real accountability as yet. Saying you're going to be a leader in ESG is one thing. Saying you're going to be top 3 in ESG, what does that mean? So we're waiting to see what various regulators, commissions, we know the gestures of intent from the UN, from the EU, and from others. We're waiting to get actually hard codification of this to come through from people like the SEC, the CFTC, and other regulatory bodies. Our investors clearly are focused on this. So this is not going away. This is thematic. And in many ways, the sooner we get clarification, the better for all of us. And, you know, we already have generated a huge amount of ESG funds, or whatever. We have to make sure, though, that investors understand that these are correctly identified. You don't fall foul of the greenwashing charges that have happened elsewhere and so on. So I think this movement is totally unstoppable, and it's what Generation X, Z, millennials, etc. want. Yep.
Thank you, Colm. James, you want to add?
I think it's, as I said at the outset, the list of things that we're worried about is long, and it was an incomplete list because we've got to focus on the immediate to sort of get through this. The ESG focus, I just came out of a board meeting. We discussed it in the Audit Committee, Nominating Governance Committee, Risk Committee, and with the full board. It is part and parcel of what every company is doing. But I think more recently what we've seen directly is the impact on German industry and particularly European energy prices as a result of the war, the Russian war in the Ukraine. I think that ironically set back the ESG debate one step and propelled it 2 steps. The step back was obviously, well, you can't have the economy collapse. You need to find energy, whether it's brown energy or clean energy, you need energy. The 2 steps forward is you better figure out a way to create energy supply which you can control and is not dependent upon somebody else cutting off pipes or pipelines. And I think, you know, look at the difference between the way the French position now versus Germany in the relative energy positions of those 2 countries, nuclear versus gas. So if anything, I think it's become, it's accelerated the discussion of ESG the recent period. But it's not something as CEOs that we can do something about today relative to making sure your organizations survive this period of transition that we're in. But it's always there on the table.
Thank you. I'm glad that the momentum is there. President Liu?
I agree with those comments, and we have never stopped our ESG steps during the hard COVID time. As a matter of fact, in China, in mainland China, ESG and sustainable development has become more and more popular. You know, MSCI, I'm not sure whether you are here today, and you have become more and more popular and welcomed in China because of your excellent ESG professional service. And in the past 3 years, a few of our customer managers are meeting in person with our clients. But we do a lot of sustainable development research, especially concerning the coal mining industry and iron and steel industry. You know, sustainable and green development is a big idea. We have to go into details. I asked my colleagues to go to the iron and steel factories and mining coal mining fields to identify which particular part of the factory belongs to green field, which we are going to make further loans to. So after 2 years' effort, we have achieved quite a lot than before. Thank you.
Thank you. We still have about 5 minutes, so maybe one more question from the floor. Yes, over there.
Hi, Brian Sack from D. Shaw. So it sounds like the panelists agree that even if central banks do their job and address the situation, we're going to come out on the other side of this with a higher average level of inflation, a higher level of interest rates. What I wanted to ask is, what's the degree of uncertainty and volatility in that state? Can we get to a world where volatility, we sort of settle down around this higher level and volatility actually comes back to the low levels we saw over the past 15 years? Or does the high level of inflation and interest rates automatically go hand in hand with a much more volatile environment than what we've seen in the past couple of decades? Thank you.
Any thoughts from our panelists? Maybe I should start from David.
So I appreciate the question, and it's a very good thing for all of us to think about. It's very hard for us because we've been living in a world where money's been so free, and the tailwind of free money, has had such a consistent impact on asset prices in one direction. It's very hard to go back to a period where you have higher embedded inflation, higher embedded interest rates, and the consequence of that. I think fundamentally that very, very loose monetary policy tamps down volatility because it's very one-directional with asset prices, generally over time. So just intuitively, you would think of the distribution of outcomes. The outcome is if we settle in with, to use James' scenario, 4% inflation, 4 or 5% rates, you're going to see a higher level of volatility than we saw through a lot of that period where money was very free. That's not certain, though, and there are other factors and other contributors, that can impact that. Policy will impact that. Economic activity will impact that. I think what we're wrestling with at the moment is there's just a lot of uncertainty as to what that path is. We all talk about the fact that we think we'll be able to navigate through. I know we'll be able to navigate through this, but the path of how we navigate through, how far central banks have to actually go to tame inflation, do they get to a resting point and make progress, or do they have to go meaningfully higher and then back up? All those things are going to have an impact. And so I'd still say that the path, in my mind, is quite uncertain, and that will ultimately play on volatility over the next 12 to 24 months.
A bumpy road. James, anything to add?
Well, I would not underestimate the importance of a healthy banking system. I'm going to sound like I'm talking the book of the people on the podium, and I am. The capital requirements for the banks and enabling the banks to have the balance sheet flexibility to intermediate markets, which is what they're supposed to do, is essential to managing this volatility. So the wrong answer would be in a period of rising interest rates, what will be high volatility with explosions sort of in different parts of the economy, for the banks not be able to play the role that they're supposed to play in intermediating and providing liquidity for the markets. And I think that's it's a policy issue of safety and soundness of the banking system, and you want the banks safe, obviously, and the banks are very well capitalized thanks to the last 12 years of regulatory reform. But you need to ensure that they're sufficiently sound that they can do the job they're paid to do, which is to drive economic growth through providing a balance sheet both as liquidity and for a lending product in the market.
Thank you, James. I'll certainly bring that message clear and loud to my regulatory friends in Basel. So with that, I will close the session. It's been a very great and rich discussion, which I don't attempt to summarize, but I hope that you've all been benefited from the insights and thoughts of our very bright minds on stage here. So I will invite you to give me a round of applause to our panelists. Thank you very much.